Remember when I told you SoFi was bottoming at 1860? While everyone else was panic selling, we called the absolute floor with surgical precision. I'm Smart Stock Sam, and if you've been following my analysis, you know what happened next. Today, we're diving into why SoFi may be shifting gears from accumulation phase, and why next week could trigger the massive breakout we've been waiting for. Institutions are secretly loading while retail sells in fear. Stay with me, because you'll see why the risk-reward has never been better and why the bottom is officially in. We issued a generational buy thesis on February 8th when everyone screamed sell. We identified support at 1860, and 48 hours later, the market bottomed at exactly 1860. Since that precise call, we've witnessed something remarkable. Morgan Stanley, BlackRock, and Wells Fargo have aggressively accumulated massive positions, while the technical setup coils for an explosive gamma squeeze. This wasn't luck. It was pure technical validation, and now the pieces are falling into place for the next major leg up. Let me show you exactly how we nailed this call with precision timing. On February 8th, we laid out a clear buying zone between $18.50 and $20. The market was in absolute chaos. Retail investors were dumping shares in panic. Fear was everywhere. Analysts were downgrading, but we stuck to our technical levels and remained disciplined. Then, on February 10th, SoFi hit its absolute intraday low at 1860. We caught the exact floor of the post-earnings sell-off, while everyone else was running scared and capitulating. Look at how perfectly that support level held. This wasn't some lucky guess or random prediction. This was reading the tape, understanding institutional behavior patterns, and trusting the technicals when emotions were screaming the complete opposite. The question is, why did the stock fall so hard in the first place? And more importantly, why is that decline now completely over? Here's where the story gets absolutely fascinating. When SoFi broke below its 200-day moving average, which sits around $22, it triggered a massive wave of quantitative algorithmic selling. These are computer programs that don't care about fundamentals, don't care about growth rates, don't care about the actual business performance. They just follow mechanical trend-following rules. The machines saw a broken technical support level and automatically dumped shares. But while the algorithms and quant funds were selling on autopilot, something completely different was happening with the humans. The insiders, the people who actually run this company and know the business inside and out, they weren't selling a single share. CEO Anthony Noto, 0 shares sold. In fact, insiders were aggressively buying in the $20 range, treating this algorithmic dip as nothing more than temporary noise. When the people who know the business best are buying shares while the robots are mechanically selling, who do you think is making the smarter long-term move? Let me show you the SoFi Paradox, the most critical chart you need to see. While the stock corrected 40% from recent highs, look at the actual business. Revenue is scaling vertically, earnings per share accelerating, member growth exploding across all segments. We're seeing a massive divergence between price and value. Short-term, the market is a voting machine driven by emotion and algorithms. Long-term, it's a weighing machine. SoFi is being weighed right now and coming up far heavier than $19 suggests. This divergence never lasts. Price and value always converge. Who else is noticing this opportunity? Let me show you exactly who's been buying. The answer is everyone who actually matters in the world of institutional finance. Morgan Stanley, and this is incredible, despite maintaining a public sell rating on the stock, they increased their position by over 33%. They are now the 8th largest holder of SoFi stock. Think about that for a second. They're literally telling their retail clients to sell while they're buying hand over fist for their own books. BlackRock, the world's largest asset manager, added nearly 11% more shares and now holds over 69 million shares. Wells Fargo, Charles Schwab, the exact same pattern repeats across the board. The smart money, the most sophisticated investors on the planet, are using retail fear and panic as a golden opportunity to build massive positions at what they view as a significant discount to fair value. These aren't small speculative hedge funds making risky bets. These are the largest, most well-researched financial institutions in the entire world, and they're all moving in the exact same direction. Do you really think all of them are wrong? The conviction doesn't stop with the big institutions either. Let's talk about insider buying activity, because this is where it gets even more interesting and compelling. The current price sitting around 1960 is actually below the zone where insiders were aggressively accumulating their own shares. When the CEO and top executives are buying at $21, and you as a retail investor can get those exact same shares for $19, you're essentially getting what I call the CEO discount. These are the people who see the full pipeline of deals, who know exactly what products are launching, who understand the margin expansion that's coming down the line. Their conviction level is at a local high. Would they really be buying shares with their own personal money if they thought the stock was heading lower? Not a chance. So what is all this actually worth, according to the professional analysts on Wall Street? The median analyst price target is sitting at $28 right now. That represents a solid 42% upside from current price levels. But look deeper at the high conviction targets coming from top-tier firms like Mizuho and Citi. They're calling for $38 per share. Even the most bearish conservative institutional targets still imply very significant upside from where we're trading today. The gap between $19 and that $28 median target is what I call the profit window. And that window is standing wide open for those paying attention. But here's the critical question we need to answer. Can SoFi actually generate the earnings growth to justify those higher price targets? Or is this just hopeful speculation from overly optimistic analysts? The answer comes down to one powerful word: growth. Unignorable, undeniable, accelerating growth that's becoming impossible for the market to ignore much longer. We're looking at a projected 54% year-over-year increase in earnings for the full year 2026. Revenue is expected to hit $4.66 billion. SoFi is rapidly compounding its earnings power quarter after quarter and is finally breaking completely free from that old, tired narrative of being just another unprofitable fintech startup. The company is not only profitable now, but it's growing that profitability and gaining significant market share in every single business segment. But there's something else here, a hidden competitive advantage that most investors completely miss when they analyze SoFi, and it's the real structural reason this company can sustain its impressive growth trajectory. That hidden advantage is vertical integration, SoFi's true secret weapon. By owning Galileo and Technisys, SoFi built its own complete banking infrastructure. They've eliminated what I call the banking tax, the processing fees every other fintech pays to third parties. This saves them $680 million annually. That's $680 million in costs competitors still pay. But it gets even better. SoFi licenses this technology to other fintechs, becoming the infrastructure layer for the entire ecosystem. They're the AWS of fintech, and this moat expands every quarter. We have three major catalysts lined up. First, SoFi cleared the profitability requirements for S&P 500 inclusion. When that decision drops, likely in March, index funds will be forced to buy millions of shares regardless of price. This is mechanical, mandatory buying. Second, SoFi became the first U.S. national bank to launch its own stablecoin, SoFi USD. While legacy banks debate blockchain, SoFi is capturing the future of digital money. Third, they're sitting on a massive $3.3 billion war chest. If deployed efficiently at 20% returns, we're realistically looking at $35 to $50 per share. That represents efficient capital deployment that could genuinely drive a doubling of the stock price from current levels. That's not hype or promotional fluff, it's straightforward math based on return on equity and the earnings multiples that other profitable, growing fintechs already command in the market today. The big payoff we've been patiently waiting for isn't some distant dream. The pieces are literally falling into place right now. We're seeing a textbook bullish divergence forming. While the price has been consolidating and moving sideways near the $19 support level, the RSI momentum indicator is actually rising steadily. This tells us selling pressure is completely exhausted. The bears are out of ammunition. The floor at 1905 has held firm through multiple tests, and each test shows lighter and lighter volume. That's a clear signal that sellers are done capitulating. The options market is loaded. Check the February 20th expiration. Massive put wall at $19 with 41,000 contracts acting as structural floor. Market makers must hedge by buying shares. Flip side, major call magnet at $21. Breaking 21 forces shorts to cover and market makers to buy, creating a gamma squeeze that could push us toward 22 or higher. Your battle plan for next week. Accumulation zone is 19 to 1975. First target is $21 at the call magnet. Breaking 21 with volume brings 22.50 at the 200-day moving average. Invalidation point is a close below 18.50. Based on institutional accumulation, insider buying, technical setup, and fundamental growth, the path of least resistance points up. Before we wrap up, here is the important reminder like always. Nothing here is financial advice. I'm not a licensed financial advisor. This is educational content based on publicly available data. Do your own research and make decisions based on your situation and risk tolerance. Trading involves risk, and you can lose money. Consult a qualified professional before investing. The institutional bottom is in. Catalysts are lined up. The technical setup is coiled. SoFi is transitioning from panic to accumulation, and the next phase is markup. The fintech rebound has started. If you found this valuable, smash that like button and subscribe to Smart Stock Sam. Drop a comment if you're buying this dip or waiting for confirmation. See you in the next one.